Hello, I'm Adam from Market Life, and welcome to the free video for Friday, September 4th, 2020. This video is a little bit different. I thought we would take a few moments and I would show you some of the analysis that we're doing for our members today. The market took a pretty hard hit today. As we measure those, it was about a 6 sigma move, which roughly means 6 times the average day's move. Big move, not huge. And I just want to show you how we are thinking about the next few trading days and what this might mean for the overall trend. Hello, I'm Adam, and welcome to the Market Life Market Review for Friday, September 4th, 2020. So we had the big decline that people have been looking for, and on one hand, this was kind of textbook, right? Because we had, as we discussed yesterday, we had the little bit of overextension here above the channel, and as we said, that is the kind of spot from which the market typically retreats and pulls back. Now, what is normal slash not normal, I mean, what's even normal anymore, right, is that this has been such a controlled market with the Fed support and perhaps the ongoing rush of new small retail traders holding up some individual stocks, that basically there have been very few dips, very few pullbacks in this market. It's not unprecedented, but it's an unusual environment that we need to be aware of. So we'll go back to the charts in a minute, but don't be overwhelmed by what you see on your screen. This is some of the kind of statistical work and research we do, and I want to call your attention to just a few things here. What I'm going to show you are some stats for days after market declines. These are the S&P futures, 24-hour futures, full history of the futures, but do be aware that only goes back to 1997. So we're not going back to like 1960 or anything like that. It's really just the history of the futures. And the columns are what happens the days after the signal. And the sheet really isn't, I also say the sheet is not really intended for presentation. It's my personal sheet, but I wanted to share some things with you today. So don't try to figure out every number on the sheet. You will go crazy. But what I kind of want to focus on here are just what happens for the next few days. And then let's also go out longer term. So we can kind of skip over what happens in the middle. And as we're looking at what happens over those days, two things to think about. One is just the number of times the next day is up. That's what this box here is. Now the numbers underneath are the baseline, which just means every single day without the qualification of whether the day was up or down. The other thing that you should, or the signal, the other thing that you should look at is the excess return, whether it's positive or negative. And if you're comfortable with stats, there is a significance test here, which is important with some of this stuff. So here's kind of the base example. This is what happens after the S&P declines 1 sigma. Now that happens a lot. That happens 15% of all trading days. It's certainly not a big move. But the interesting thing is, even with that, do you realize there is a positive edge? And this is why there are a lot of systems, and we've talked about this, there are a lot of systems that do nothing more than just a very few simple set of conditions that are based on going short after the S&P is up a few days and going down, or going long after it's down a few days. And of course, those systems have suffered over the past few years as we've seen some of those relationships break down. But this is one of the truths of how the market trades, is this kind of day-to-day reversal. So that's 1 sigma. Now I'm going to change here. Now we're looking at 2 sigma. And what you should notice is, first of all, the sample size gets smaller. It's unusual. It's 4% of trading days, but we still have the same tendency, right? There still is a small edge to be up the next day, and there's a positive excess return. Without commenting on each of these, let me just take us through 3 sigma. Today's close in the S&P was almost 6 sigma, so let's just look at 5 sigma trading days. So if you were to buy after any random 5 sigma day, down day, you would be up 77% of the time the next day. And that's versus just a little bit more than 50%. That's fairly significant. The average return, the average day's return is 1.4% following days like that. Now, before you get excited and rush to buy, there is a major thing we need to be aware of. and this is where market structure comes in. It's also interesting, by the way, let's just look at this daily chart, and these are the sigma spikes down here. Most of you know that, but you can see that this just kind of pulls out some of the big days over the past year, and you can also see that this is, despite everything we've been through this year, this is the biggest volatility adjusted daily loss on the S&P in quite some time. So that is kind of interesting food for thought, right? You can just look here and see that so far this day really is not that different than what we had back in June, and the follow through was telling there, right? We had no clean setup for a short. So there are two things to think about here. One is the follow through. We'll talk about that in a moment. And the other is market structure. If you go through and isolate these days for only pulling out the days where the market was in the upper part of the Keltner channels, watch what happens. Now what I've done